Welcome back, everyone. This is Dr. Mark Dennis, and you have tuned in to our Week 3 live chat, part number 1 for Finance 4501 Investments. This session is all about laying the foundation for how we analyze investments using a structured approach. We're going to walk through fundamental analysis, the business cycle, valuation methods, and even more. Let's dive right in. Starting with the basics, fundamental analysis. This method is all about evaluating the drivers of firm value. We try to forecast earnings and dividends by looking at the company's environment from the top down. First the economy, then the industry, and finally the firm itself. Think of it as zooming in from macro to micro. This approach helps us understand the full picture before making any investment decisions. The primary objective of fundamental analysis is to produce a value that an investor can compare with the security's current price, aiming to figure out what position to take with that security. For example, if it's underpriced, we buy. If it's overpriced, we sell or perhaps simply choose to continue holding it. The top-down approach helps investors identify the most promising sectors and companies in a thriving or recovering economy, or conversely, those sectors and companies that are likely to outperform during economic downturns. When we say top-down, we're not talking only about the U.S. economy. Global performance matters, and it matters quite a bit. Countries and regions can vary dramatically in terms of political risk, policy decisions, and economic growth. For example, a company doing business in emerging markets could face sudden currency controls, or perhaps benefit from a favorable trade agreement. These global interconnections are powerful, but also unpredictable. This variability influences both the risk and potential return on investment in different markets, making it critical for investors to consider the economic stability and prospects of the countries and regions in which they choose to invest. When analyzing a company, it is not sufficient to only consider the domestic economic context. Global economic linkages mean that events in one part of the world can affect companies and markets elsewhere, often in complex and unpredictable ways. As an example, the 2008 global financial crisis illustrated how interconnected the world economies are and how domestic events can have far-reaching global impacts. A thorough fundamental analysis will therefore incorporate an assessment of both domestic and international economic conditions and political situations to build a comprehensive picture of the potential risks and opportunities facing a particular investment. Let's discuss currency and exchange rate risk. This is something many investors overlook, but it can make or break a company's profits. Consider a few quick examples. A ski resort in Colorado. An appreciation of the US dollar could make vacationing in Aspen more expensive for foreign tourists, potentially reducing international visits and affecting revenue. Conversely, a weaker dollar makes the US a more attractive destination for tourists, which could increase visits and revenue for the resort. How about an exporter like Rocky Mountain Log Homes? If the dollar strengthens, it becomes more costly for international customers to purchase these log homes, possibly leading to a decline in sales. If the dollar weakens, Rocky Mountain Log Homes products become relatively cheaper abroad, potentially boosting international sales and profits. How about Toyota cars selling in the US? A stronger dollar against the Japanese yen increases the value of profits repatriated to Japan when converted from dollars to yen, enhancing the reported earnings of Toyota in its home currency. If the dollar weakens, the value of U.S. sales converted to yen decreases, resulting in lower profits for Toyota in yen terms, which may affect strategic pricing and investment decisions by the company. Foreign exchange rates play a crucial role in the global economy and can significantly affect the competitiveness and profitability of U.S. firms and their international counterparts. Exchange rates influence the cost of exports and imports, the valuation of foreign income, and the economic landscape within which businesses operate. So what exactly does exchange rate risk influence? Pretty much everything: sales, profits, stock returns, and even investor perceptions. Some companies will hedge this risk using options, futures, or swaps, but not all do it well or consistently. As investors, it's important to look at how companies manage their currency exposure. Exchange rate risk, also known as currency risk, arises from the change in the price of one currency against another. Investors in companies that have assets or business operations across national borders are exposed to currency risk that can impact sales, profits, and the value of their investments. Currency fluctuations can also alter the competitiveness of a firm's products in the global market. A stronger domestic currency makes exports more expensive and imports cheaper, potentially reducing sales abroad and increasing competition at home. The quantity of products sold and the revenue in the home currency may vary due to exchange rate movements, even if the price in the foreign currency remains constant. The profitability of a firm operating internationally is directly affected by global exchange rates. Currency movements can either enhance or erode the profit margins of cross-border transactions. For companies with production facilities abroad, a weaker local currency can reduce operational costs when converted back to the home currency, improving margins. Companies face transaction exposure when they have receivables and payables denominated in foreign currencies. The value of these transactions can be positively or negatively affected by currency movements at the time of settlement. Exchange rate movements can influence the stock returns of companies. Investors holding international stocks may find the value of their investments fluctuating due to changes in currency values. Investors may perceive a company as riskier and discount its earnings if it has high exposure to currency fluctuations, thus affecting stock prices. For multinational corporations, dividends that are repatriated from foreign subsidiaries can be worth more or less in the home currency terms, depending on the exchange rate, which affects the income received by investors. Companies and investors alike may use various hedging strategies to manage exchange rate risk. These can include the use of forward contracts, options, and swaps to lock in exchange rates and protect against unfavorable movements. Once we've assessed the economy and global risks, we move on to industry analysis. Here we ask the question, is this a competitive industry? What are the barriers to entry? Who holds pricing power? After that, we zoom in further to the company itself, looking at its strategy, individual financials, and risk profile. That's why the top-down approach is so useful. It helps us understand context before diving into individual stocks. Industry analysis is a critical component of fundamental analysis, providing insight into the competitive dynamics that can affect a firm's profitability and long-term viability. It includes assessing the market structure, degree of competition, barriers to entry, regulatory environment, and the potential for substitute products. A company analysis involves a deep dive into the strategic position, financial health, management team, operational efficiency, and market share of a firm. It is through this detailed analysis that investors can identify a company's strengths, weaknesses, opportunities, and threats, and evaluate its growth prospects and risk profile. The top-down approach in fundamental analysis starts with the broader economic context because macroeconomic factors can have a profound influence on industry conditions and individual companies. This method helps to filter out the most promising sectors or industries before investing significant effort in analyzing individual firms. By understanding the big picture first, investors can better contextualize the company-specific data within the prevailing economic and industry trends. Some advantages of top-down analysis. It allows for a more structured and systematic approach to investing by prioritizing the analysis of factors that could have the most significant impact. The approach can be particularly beneficial in identifying cyclical trends and capitalizing on macroeconomic-driven market opportunities. By using the top-down approach, an investor can align their portfolio with their macroeconomic outlook and risk tolerance, potentially leading to better risk-adjusted returns. For students of finance, understanding the rationale and implementation of the top-down approach is essential, as it forms the foundation of investment analysis and portfolio management practices taught in academia and applied in the investment industry. Next, let's discuss the business cycle, because timing does matter. The economy moves through predictable stages: expansion, peak, contraction, trough, and back again. Unofficially, a recession is often thought to be defined as 2 successive quarters of falling gross domestic product, or GDP. Officially, the National Bureau of Economic Research declares whether the economy is in a recession and the exact start date. Not all industries perform the same at each stage. Knowing where we are in the cycle can shape how we allocate investments. Let's build on this with a look at a concept known as sector rotation. We now discuss the concept of sector rotation, which is a strategy used by investors to capitalize on the economic cycle by allocating investments among different sectors of the economy. Sector rotation is predicated on the observation that not all sectors of the economy perform equally well at the same time. The performance of these sectors can often be predicted based on the stage of the business cycle, which consists of the 4 distinct phases discussed previously: peak, contraction, trough, and expansion. Sector rotation is the strategy of shifting investments into industries that tend to outperform at different points in the cycle. At the peak, you might favor natural resource firms. During a contraction, shift over to defensive firms like utilities or healthcare. At the trough, consider industrials and transportation. During expansion, move into cyclical industries that benefit from rising demand. This is where timing and macro awareness can potentially enhance returns. However, it is difficult to achieve above average returns this way because often we don't know which phase of the cycle we are actually in until much later. Furthermore, the duration of each phase also remains unknowable. Here we see a visual of that concept. You can see how different sectors rise and fall with economic conditions. This is more art than science, of course, but it is a useful framework for thinking strategically about where to invest. Continuing with our examination of sector rotation illustrated here, let's explore the strategic positioning across various sectors as they correspond with different phases of the economic cycle. This cyclical movement is grounded in the performance characteristics of each sector in response to economic changes. In the expansion phase, the energy sector often thrives, supported by increased demand that accompanies a robust economy. As production escalates across industries, energy consumption rises, typically enhancing the profitability of businesses within this domain. As the economy eventually begins to contract, a shift towards sectors such as healthcare and consumer staples is observable. These areas tend to exhibit resilience due to their provision of non-discretionary goods and services, which remain in constant demand. Utilities also tend to display relative stability during downturns, given their essential service offerings. With predictable cash flows, utility companies can offer a safe haven during times of economic uncertainty. In the financial sector, the seeds of recovery may foster growth as rising interest rates often boost margins for lending institutions. The uptake in economic activities can lead to greater demand for financial services. The segue from recovery to a new phase of expansion usually heralds a favorable period for technology and consumer discretionary sectors, buoyed by elevated consumer confidence and increased capital expenditure on technological advancements. Finally, materials and industrials are poised to capitalize during the later stages of expansion as demand for raw materials swells and manufacturing outputs increase to meet accelerated pace of an expanding economy. Investors who adopt a sector rotation strategy might seek to preemptively adjust their portfolios, favoring sectors expected to outperform during the impending economic phases. This proactive approach can potentially enhance portfolio returns relative to the broader market. Let's now pivot into valuation. How do we know what a company is worth? One method is book value, which is the accounting value of equity based on the balance sheet. But here's the catch. Book value relies on historical costs. It doesn't always reflect current market realities. Also, intangibles like brand equity or human capital do not appear on the balance sheet. And yes, it is possible for market value to drop below book value. It happens from time to time, so don't treat book value as the floor. In contrast, market value is forward-looking. It reflects what investors think the assets are worth today based on stock price. This makes it a better reflection of perceived investor value than does book value, though it too can be influenced by sentiment and short-term events. Another approach is liquidation value. Basically, if the company were to shut down today, what would be left after selling off assets and paying all of the debts? If a stock trades below this level, it might attract takeover interest. In that way, liquidation value sometimes acts as a price floor. It is particularly relevant in distressed or undervalued situations. Next up, replacement cost. What it would cost to rebuild the company from scratch.
This can act like a ceiling on value. If market prices rise above replacement cost, new competitors may enter the market and drive down profits. Think of this as the gravitational pull of competition. It limits how high valuations can realistically go in the long run. Finally, let's talk about the holy grail of valuation: intrinsic value. Intrinsic value is the present value of all expected future cash flows from the stock, which typically include dividends as well as the future sale price for the stock, all discounted at a required rate of return. For a 1-year holding period, the formula is simple. Intrinsic value equals the present value of next year's dividend plus the expected sales price, both discounted at the required rate. The goal? We would like to buy when the market price is below intrinsic value and sell whenever it is above. All right, that wraps up part 1 of our week 3 live chat session. This has been a rapid fire overview of key analytical tools: fundamental analysis, the business cycle, sector rotation, and valuation approaches. As always, anytime you have questions about these or related topics, let me know via email or the course portal, or you can always text or call. Stay tuned for part 2, where we will go deeper into price to earnings ratios and options contracts. See you online.